Today, we want to talk about debt and how intense things can be with business. And this is something that we had a big experience with our brand as we started out and tried to get things going. And Stan always has a good opinion on things with debt, just with the mathematical side and the number side of things. And with the different businesses you see, being entrenched with our businesses as well, debt can be a very scary, scary thing and very difficult to navigate for a lot of people. And obviously early on you saw where I was with everything, and it certainly is a very suffocating feeling. And essentially for me, it was just treading water to try to get through it. So I think having a discussion about debt and what we've been through could really paint a clear picture for, a lot of people who have followed our journey or just doing their own thing and maybe tagged along a little later in the journey and don't know a lot of the stuff that we've been through. But excited about today's episode because this one's going to be pretty cool to talk about.
It is one of the most, with my accounting clients, one of the most common things that come up, whether it's an issue or questions about how to use it. So when we talk about debt, we're talking about credit cards, loans, lines of credit. It could even be you have a vendor that you owe money to, some bills that you haven't paid. So all that would be debt that we're kind of talking about. Debt isn't necessarily a bad thing. It's just a tool that you probably more likely than not hear it being misused. And that's why it might seem scary for some people.
Well, even for us at this stage, we're discussing right now taking on debt for expansion. And for the last 4 years or so, 3 years, or I guess Mount Washington's location as well, I just wanted to pay for everything. And I loved the feeling of not having debt because I was so engulfed in debt before. And I think now, because I'm understanding it more, to your point, that it's not necessarily a bad thing, it's a strategic thing if used right. In the beginning, for us, it was a strategic thing to survive. Now we're trying to figure out how do we implement it for a strategic thing to grow. And that's the big change.
Yeah, it helps if you have a solid plan, because it's not that, sometimes it's what you use to test things out. If you think you have a solid plan, I'm going to go get this loan, I'm going to use it to do X. Clients do that a lot where I'm going to go get a $50,000 loan, say, I'm going to invest in some advertising and that's going to grow my revenue and I'll use that money to pay back the loan. But if the ad strategy flops, then you just have $50,000. It didn't get you anywhere. And now you have to pay that back. And that hurts your cash flow. That lowers your profit because you have interest. That's where people start to spiral, is then they try and make another decision that involves debt. And they go down, well, I'm going to get a different loan and try something else. And then before you know it, you have tons of debt. So at the beginning, that's similar to what you were doing at the front end. You were trying different things. Not everything always worked right away. And you ended up with a large amount of debt.
Well, and I think my situation was so unique because in the early stages, it was all about survival purely because of timing of things that were happening in my life as well. Paid off a student loan. It was $110,000 or something around there. The year before, I just built a house. So a lot of my cash was gone with that. And I didn't save as much up to as quickly as I possibly could to give myself a little bit of a runway. And then obviously the early stages of business, it's so hard to grow, it's so hard to get going, that I didn't understand how difficult that would be. So in a perfect world, I would have not gotten fired at the time that I did. But at the same time, if I didn't get fired, then who knows if I ever would have taken the jump to do that. So, and even now I still think about debt, and I pay off. You see me with the credit card. I pay it off like every day I can. I log into PNC, I check Amex, I compare. I'm like, okay, cool. And I just try to pay that off. So, now I'm kind of running in the mindset of I'm building a house, have a couple cars. I'm okay with that type of debt. That's more of a controlled debt, where the other stuff, I just don't want to have any credit card debt lingering in any capacity. And that's kind of what I'm navigating right now, to understand that there's some debt with the businesses that we're going to take on that's okay. But it's just a scary phase, especially when you are at the bottom and you get through everything and you clean out. And when you get clear of all that debt, now I'm sitting here like, damn, I'm, have a little bit more debt than I had before, but I'm okay with it now, because it's all things that I want, versus before it was just survival mechanisms.
That's where, are you in debt or are you using debt as a tool? It's a lot easier later in your business life cycle to use it as a tool, and you have access to better debt instruments, better terms, better interest rates, things that you might have accumulated some assets that can secure some debt. So one of the things when you're starting out to look for when you're signing debt instruments, whether it's a credit card, loan, line of credit, is it secured or unsecured? Secured means there's an asset that's backing it. So a lot of times I'll see maybe not the best decisions where people are starting a business and if they own a house, their personal house is the collateral is securing some sort of business loan. And that's one of those, ideally you don't do that if you have to, and that's the only asset you have, and that's the only way to get the loan, and that loan is the only way for you to do the business. You just want to make sure your plan is pretty rock solid.
Well, so let's just kind of dive into that itself. We know, and I know from experience, that at the beginning, that's really your only option. So there's not really a, if you can't do this.
Yeah, unfortunately.
Unfortunately, that is what it's going to be. You are going to have to do that. I had to do it. I still had to do it recently on some other stuff where I personally guarantee things. Fortunately, we're now at a spot now, volume-wise, that we're doing so well, where we're getting a lot more flexibility. But even as the leases and things of that nature, as we expand, a lot of that personal guarantee falls on me, or as we navigate the growth on you guys as well. So really, the early on entrepreneurs, I don't want the false hope to be that there's going to be this opportunity for them not to have to personally guarantee. Again, not giving advice in any capacity, I don't see that happening based off of my experience.
I don't see it happen a lot. Maybe you can get a tiny credit card for a couple $1,000 limit that you don't have to personally guarantee, but most of the time, and to be clear, personal guarantee is a little different from secured or unsecured or collateral. Personal guarantee means you as a person are saying you're going to pay this off, and then I'm not exactly sure how it works, but I'm pretty sure you have a little more flexibility as to what you personally use to pay that debt off versus collateral, like your house is the bank that has that debt instrument has a right to your house, kind of like a mortgage. If something were to go wrong and you can't pay that business debt, they have options to pursue in regards to a specific asset. So it's kind of two different types of things, but personal guarantees are almost unavoidable until you have some business assets that can secure the debt. Or you get big enough that your operations, the cash you have at the bank, they're more willing to give you an unsecured debt. And that's where lines of credit can come into play, where it's unsecured. They won't give you as much. The interest rate might be a little higher because there's nothing against it. If you were to default on it, maybe there's a personal guarantee they could go after, but that's not the same as collateral.
Well, and that's so even with you just mentioning the higher interest rates, like that's kind of where my mindset goes. I'd rather pay a little higher interest rate to be less tied to something as well, especially because I could calculate I have to live in this situation for X amount of years or X amount of months until we pay that loan off. And then you just navigate to your personal life of how much money can you just focus on paying back to that to get it down. So okay, cool. You have $100,000 you own. Can you pay it off in 5 months, 4 months, 3 months, a year, 2 years? All that's going to be dependent on your lifestyle and how much money's coming into the business as well. And are you okay with that? And I'm okay with that, or I was early on. Now I want to use the relationships and the things that we've earned to have the best rate possible in scenarios. And thankfully, we have a lot of clients in different industries that can help us navigate those things. And our relationships with banks are just simply different as we've navigated this side of it. But it's definitely an intimidating and scary thing in the beginning, especially with the first set of things you're trying to sign from acquiring debt standpoint. And you just don't know what you don't know in the beginning. But you also do things that you just have to do in the beginning because that's the only option. And I think that's the big thing that a lot of early stage entrepreneurs have to wrestle with is you just have to really believe in your product as well. Now there's that false hope that you might just be believing in something that's not tested or true. So you want to dip your toe in it as slowly as possible. But sometimes there's no option and you just got to take the debt and figure it out as you go.
Even so, to the example of like, it is hard to get debt even at the beginning. When we started the closet company, we are 4 entrepreneurs that between the 4 of us own close to 20 successful businesses, and we could not get financing for the van. I think we got declined from 3 different lenders.
Yeah, it's insane.
We did get one, but it just that's just not important to banks, kind of, sort of.
And one of our partners has an 8-something credit score. Mine's 750 now.
So credit score is the other thing. We all have great credit scores as well. And it's still, they just didn't want to because it was a brand new business. It didn't have any tax returns. It didn't have any financial history. So that's, I talk to bankers about this a lot, is that old timey relationship that you used to be like, they believe in you, they believe in the business, they look at your business plan, they want to invest in that. That is harder and harder to come by. And it's more just about show me the numbers, show me 3 years of tax returns, show me audited financial statements, your business plan, your idea, believing in you. That's where private equity or other types of lending come into play, not necessarily traditional banks.
Yeah, I don't think banks obviously have the flexibility that they've had in the past. And I'm such a relationship person that used to irritate me so much that banks just couldn't do anything. But they do. They have this formula that they figure out. Obviously, the more successful, then they're going to see where you're going, so they're going to want to earn that money from you, which is kind of funny now. Like, we're dealing with that stuff all the time, and people are reaching out to us. Hey, let's chat. How can we help you? How can we be an asset to you growing your business? And I still have a little bit of scar tissue built up from the past where it irritates me a little bit as well. At the same time, I understand, like, I get it, but it kept a little chip on my shoulder about that stuff. So now if a bank wants to do something with me, I'm going to hammer the hell out of them to get the best rate possible in any capacity, or I'm just going to tell them, hey, I'm going to go to a different bank, and here's the bank, and here's what they're going to do for me. Because I just, at this stage, I want what I want. I'm no longer going to sit here and let one person say we can or can't do that. The relationships are too strong elsewhere, which is a great spot to be in. But at the same time, there's still only so much they could do.
Yeah, and it's not, I don't want to hate on the bankers. It's just the bank, the regulations, whatever it is. We have good bankers that we work with.
For sure.
So.
And they've done a lot now, they've done a lot for a long time now, and that's exciting. And we certainly appreciate that side of it. It's frustrating because I'm such a handshake type person, and if I say I'm going to pay something and do something, it's going to happen. So in my mind, I get so frustrated knowing that this is the safest bet you can make as a bank to give me money, because I'm not gonna not pay you back. And that's where it's kind of like I get frustrated knowing the integrity that I have on just how I do business, but that doesn't mean anything to a bank, and it shouldn't, because most people's word isn't gold with that stuff as well.
So that said, there's a lot of online companies that are aggressive about their marketing that will say they'll give you any sort of money. If it's really easy to get money from someone, you want to be careful, tread lightly, maybe have an attorney look at the contract or an accountant run the numbers for you. Because those, I see clients come to us that they just kind of got screwed. They're terrible loans. They're really bad interest rate terms. Sometimes they'll trick you where if it's like, hey, I'm going to lend you money for 4 weeks and the interest rate's only 10%. That's 10% per week, not 10%
of the total
annual rate, which is what most of the time when you're looking at interest rates or things that banks advertise, it's the annual percentage yield, which takes it across the whole year. If someone's giving you 10% for the week, you have to multiply that by 52 weeks. That's a 520% interest rate that you're paying.
Yeah, that's pretty wild. And I don't think I understood that at all, especially with like the Square stuff. We talked about that on one of the episodes before, and it was just, hey, click a button here and 30 seconds, you're approved for this. And then I was like, this is the most fantastic thing ever.
A little too easy.
And then when it came back to every transaction was losing almost 20%, it was just like, holy hell, this was a terrible decision. But it also bought me another 6 months.
Right. That's hard because when you're trying to survive and it's that or nothing, you don't have any options. But if you can plan ahead, that's where, if you have time to compare loans, or you're trying to pick what kind of credit card should I get, check on the terms, check on the interest rates, check on the flexibility. Long-term loans, prepayment penalties are a good question to ask. The thing about personal guarantees or secured or unsecured, generally you probably don't have an option, but it doesn't hurt to ask. You never know if they might say, oh, well, maybe we can do, a lot of ours that we do now are personally guaranteed for 5 years, and then it drops away.
When we had something recently, it was a 2-year.
We do the leases where we'll guarantee it for 2 years. By then you'll see our business performance in the new location. So we don't need a guarantee after that.
And even from a mindset standpoint, when obviously this is all about helping entrepreneurs and whatnot. So shifting from not just the debt conversation to the mindset of an entrepreneur that's going through the debt standpoint, I'm okay with signing personal guarantees because I know the business is going well. We have so much data that continues to reassure the direction we're going. So despite someone else saying, hey, be careful, limit the amount of personal guarantees that you have, I still know what's happening. And it's like, okay, cool, big deal. I have to sign a personal guarantee. If it fails, we fail as a company anyway. So I'm screwed.
The only time I really saw it come into play a lot was during the pandemic, where people weren't working. They were trying to get out of their leases. Lease is kind of another form of debt, or it's a covenant to pay that you're agreeing to. But that was the time when people were trying to get out of their leases because nobody was allowed to work in the offices, but they couldn't because they personally guaranteed it. So,
which is crazy to think about. I mean, that was a real situation not that long ago. And it was a situation that no entrepreneur, no human being on earth could have saw.
yeah.
And that's the crazy part about that is there are things, and hopefully that never happens or nothing like that happens again. And I don't think it will at this point, but it could happen.
Yeah, those act of God clauses that are in contracts, that's where you need good attorneys to check on that stuff. Most of the time, people take your opinion where everything's fine, nothing to worry about, or it's all going to shit. So like, what's more shit on the pile of shit?
And people, we tried to get a lot of the act of God stuff out of the contracts and the leases and whatnot. Since COVID, that's been a sticking point, and it's almost like impossible to peel out of a lease.
Yeah. So who's to say about that? But that just questions to ask. It never hurts, especially if you have a money market account. This isn't debt, but this is just a little trick with banks. If you have a business money market account and they give you a rate for 3 months and then it drops to nothing, if you just call them usually and say like, hey, I was going to move my money unless you can pop this up to 3.5% right now is roughly the average for businesses. They usually do it. So that's like an easy thing. If you have a decent banker, just give them a call and say that, get some free money. Back to the debt though. The spiral is rough, and what you're saying with the Square loan is kind of a hidden cash trap where it seems like debt fixes your problem, but debt only fixes money problems. It doesn't fix like systemic business problems. So if you have a bad business model where your cash flow is just radically wrong or you're not profitable, the debt only is a Band-Aid to a couple more months down the road, and it makes those months harder for that period of time than they currently are because you have to pay the debt.
It was the hardest thing ever was going through that.
So that's like the hidden cash trap is I need to make payroll. I need 10 grand. I'm going to go get a loan. But then from now until you pay that off, that period of time is harder for your cash flow. So you want to make sure you factor that in. Some people think I just need the loan now to get to this place where my customer is going to pay me. But they've lowered their ability to be profitable during that time. So now they need another loan because they weren't factoring that in, and they're just kind of stepping down their cash flow and their profitability. So you want to make sure debt is used to get you to a place where you're more profitable, or it's opening up an opportunity for you. Like maybe you're in manufacturing and you need machines and a building and things to get you to be profitable. Or when we started the closet business, we needed a van. We can't install closets without being able to transport them to people's houses. So we need that van. So we know we're going to take on some debt now to be able to make money. And we knew, because we did projections, that it will be enough money to pay the debt and be profitable and all the other things.
When I remember, I think whenever around the time of the Square loan, I want to say we weren't doing a ton of revenue, if I remember correctly, but there were smaller months for sure. But I do remember the first time that money went into my account, it at least bought me a sense or sigh of relief. And in my mind, it was always about, we always talk about the light at the end of the tunnel, just don't know how far the tunnel is. That's really where it gave me peace, was this bought me more time. And I know that with more time allowed me to build more and do more, because the decision on that loan was, hey, the business is going in a good trajectory. We're still not making as much as we need to make, but if things keep happening in the pace that they're happening, we know time versus money coming in, eventually there's going to be a break-even point. Things are going to flip, and then it's going to be allowed to go into the pocket, and everything's good. So I do remember from an entrepreneurial standpoint that once we got that loan approved, it gave me a sense of peace, and it gave me a sense of, okay, cool, I live to fight another day, or fight to live another day, whatever it is. And I truly, that was such a powerful thing from a psychological standpoint on my end, to have peace, to focus on the business and not be terrified by not having any money. Even though I knew the money wasn't going to last long, and even though I saw how quickly it was bleeding out, whatever that feeling that I had gave me peace, comfort, and allowed me to say, cool, fuck it, keep going forward.
So much of money concepts in general, but debt especially, is behavioral and psychological and emotional for people. It's hard to detach and just look at the cold, hard numbers. And again, if you're in a situation where you need debt, hopefully you have enough time to kind of look around. So you pick the least worst option for yourself, because they're all probably going to be not great at that point.
Well,
But
and I think that's where I really, really, really recommend any entrepreneurial person. That's where knowing your numbers is so vital. And that's where you came into such a huge role in my life. And early on, my dad always said, know your numbers, know your numbers. And I was like, cool, whatever, we'll figure it out down the road. But had I not had you by my side every month hammering the books to explain what was happening financially, I would have never truly realized how much money we weren't making to pay back the debt that we had taken from Square or whatever it was. So I would certainly recommend any entrepreneurial person have somebody near you. If you are going to take a loan from somebody, if you are going to take debt from in any capacity, have a plan, review your numbers on a day-to-day basis and a monthly basis, and figure out how do you pay that debt off as quickly as you can, or how do you strategize going through the phase of business you're in for whatever time you think it's going to take, and be real with yourself, because the numbers don't lie to you, and they're the only way to truly understand how do you get out of the situation you're in. Without that, you'll never get out.
you need to know the terms that you're working with too. Even if you have to, like the Square loan, it was taking portions of the credit card. So just knowing that, you can operate slightly differently to make it even more efficient for you by taking more checks and more cash that won't pull that money out of the portion of the credit cards that they were processing. I have some clients where we do if you get too far into debt and we're trying to figure out a debt repayment plan, prepayment penalties, if you don't know those are there and you're like, whoa, I made all this money, I'm going to go pay down this loan, it's going to be great. And then you end up paying more money than if you would have just held the loan because of prepayment penalties. So we have some where you can map out, you should pay this one first, this one second. This one you're never going to pay off more quickly. You have to literally wait till the end of the loan, or usually it's like 5 years, or there's a certain time period you wait. And then after that, there's no more prepayment penalties. You can pay it then. So it's like, yeah, you do have to pay the interest on this for the next 2 or 3 years, but that's cheaper than trying to pay it all off now. So it's one of those, emotionally, you might want to be out of debt, but the numbers say you'll have more cash now and you'll pay less interest overall if you wait those couple more years till the prepayment penalties are gone and pay it all then.
Would you say that the prepayment penalty side is probably one of the easiest things to navigate, because so many people will offer something without having a prepayment penalty, essentially?
Yeah, one of the options we were looking for expansion, they gave us different terms. I think it was 15 years. There was no prepayment penalty, but anything longer than 15-year payback, so 20 years, then there's a prepayment penalty. So then you don't have the option to pay it faster. So we just right away said, well, we won't go past 15 years because we want that option. If we're killing it, we want to wipe that out and move on to the next one.
Yeah, our goal with that is to stretch it out as long as we can without having the prepayment penalty, just so we could take the first year, 6 months, whatever, 2 years to build everything up, get the cash reserve, and then pay stuff off. We know we're going to pay it off in 2 years or 3 years or maybe who knows. But having the ability to make that with elongating that payment as low as possible is kind of the goal and the strategy that we had.
Because most likely for us, the first year and a half, we're going to be making the minimum payment as things grow and get up to speed. But then those last year and a half to 2 years, we're going to be aggressively paying it down. So if you go 25 years, you don't have that option. If you go 5 years, you have to pay way more upfront than we want to pay. So this gives us the flexibility on both the front and the back end to navigate within the terms that are there. So it gives you more flexibility. And the interest rate was only a little bit different between the 15 and the 20. So why not have that option?
Yeah, for us, it just made sense because, again, especially any business in the beginning stage, now we have multiple locations, so we have a pretty good idea of what's going to be going in and out. But if this was our first expansion, then we certainly would want to be as cautious as possible. we could probably, I mean, there's not really a reason other than the extra percentage or so for us to go shorter from a term. So it was like, why even do that?
For us, some people, it's a cash flow thing. You can't make that 15-year minimum payment every month. So you have to go to the 20 or 25 because it's a smaller monthly payment that you make, even though it'll be more interest over time. So it just depends on your cash flow too.
And would you recommend then, this is one of those situations, just like anything in business, you talk to as many people as you possibly can and figure out who's going to be the best fit for you, your style, what you need from a business standpoint, your industry that you're in. Also, do you like the people you're working with or not? Because they're taking your money back. So you want to have somewhat of a little bit of a positive feeling about them as well. But also you want to think long-term perspective. This is the first loan that I'm going to do with this bank or this banker or this PE, whatever it may be. Do I like them, and do I want to test this first loan to see how the relationship is, because I have plans of expanding even more or growing even more, and there's going to be more money that needs to be asked to be lended from that group. So you really have to understand that dynamic, and how easy were they to work with, how flexible were they to work with, how supportive were you through that. Was it pretty much, hey, you sign this, boom, you move forward, and that's it, which is how it should be. But there's that relationship that is intangible as well, that certainly helps in situations if you need help in some capacity. Or you just start having that good relationship and rapport, and then maybe all of a sudden you need a secondary loan, and that first loan isn't paid off completely yet, but they see that you're making good payments on there and they have some little bit of pull. They see your business is growing exponentially because of that. Then typically things could potentially change, or you could get more debt.
Debt covenants are another part of that. If you have a relationship, you can negotiate on those. That's where yearly, quarterly, monthly, the bank will require you to do something or meet some sort of metric and prove it. So it might be once a year you need audited financial statements. It might be once a year we just want you to send us your tax return. It might be you need to make so much in revenue or hold so much in assets. Those are the types of things where it can open you up to more debt if you have a little bit of a relationship, and they can alter those.
Do you have thoughts from people out there, large banks, small banks, credit unions, non-credit unions, loan sharks, private equity? I mean, there's so many different...
Loan sharks probably not unless you have to.
Right.
We've been talking to a lot of bankers and stuff lately. Some people are pretty good about saying we just can't do that, or we're not going to be that person. Some people I say, like, we tell them the expansion plan, we're looking for a partner over this period of time, we're going to need a lot of funding. And they just say like, oh, we might be able to do one, but that's probably it, maybe two. They're just not interested. Some banks don't work with businesses. You have to ask if they're business friendly, how many businesses, clients do they actually have, those types of things. Like the online stuff, I don't want to name companies, but if you message us separately, I will let you know some companies that I've seen go poorly. They're taking advantage of those people that are in situations where they have to do something or their business is going to go away. So they know that the terms are based on that. Like I said, if you annualize it, the rates are much higher than what they actually advertise. And the payment terms usually aren't great. They're taking money out once a week, maybe. I've even seen some that are daily. So it makes it harder for you to try and build up a cash reserve to pay your payroll because you're always got this coming out. It's just back to knowing what you're agreeing to. Some people I see are surprised. They're like, they're hitting me every day. I didn't know it was going to be like this. Well, you need to look at the contract. You need to make sure you understand the terms.
Well, I think too, online banks are businesses. Right. So you have to look at it from that standpoint. That could essentially just be somebody who's really, really good at marketing and advertising and has some form of a financial backing to then sell you on that. But they could sell the sizzle of what they're trying to do to you. In the world of digital targeting, digital advertising, it's going to be a prevalent thing. And even from a PE standpoint, we were looking at potentially selling our marketing agency, and it's so early on, we decided not to do anything, but we had a couple calls, and it was just interesting. There was a group out of California, I believe, I think California, and their focal point was quick closing on selling a business within 90 days, but you're going to get 1 to 1.5 times EBITDA from a payout standpoint. So it's like that was a different model than before. So if you're strapped for cash, there's people that are willing to buy a business at a discount potentially, but it's still a profitable sale and exchange. And then you just have to make sense to what do you want to get out of your life? So we're seeing a very interesting, evolving way financing is done online. That's probably going to continue to change aggressively with AI and with other things that are happening in the future, and also with banks being a little bit more challenging to work with. And there's going to be somebody that's coming up with something creative, because there's this entrepreneurial dream is well alive in America. And there's just, with that being said, there's a lot of business owners who shouldn't be business owners, and people are going to take advantage of that purely because they know people are going to need money and need help. And that's kind of scary to think about.
It is wild, especially with the niche of things. A lot of small businesses, which I like and I recommend, is becoming a niche in something specific. So a lot of those lending companies are niche for a specific situation, but they advertise to everybody. So you might view it as a good thing, when for you, it might not be a good thing. For you, it might be a bad thing. It might be the opposite of what you need. You're not in the situation that they're really trying to target, but you got targeted with the ads. And if you don't know, don't just assume what they're telling you is a good thing. Because I've seen marketing where I'm like, that's a bad thing, but you're telling me it to me as if it's a good thing that I should be happy about. So just watch out for that too.
And people, like, let's be real here. The resources of ChatGPT and every other thing can also help you if you don't have somebody that's trustworthy, that you don't have the go-to financial guy in your pocket. There's tools to protect yourself as well, to at least educate yourself even more. And you're going to get some pretty good data just by entering things in here. Here's the situation, here's the bank, here's the terms, here's this, here's that. Or you can just straight up upload the term sheet to ChatGPT or Gemini, whatever, Grok, and then it will pull and compare things for you, just like we do for our resumes. We pull different things there. So there's no excuse. It's just, don't be stupid, don't be lazy, figure it out on your own.
Don't sign up for debt in a short period of time. If you need it tomorrow, you should spend the full 24 hours doing as much research as possible. And if you find yourself in debt, you could talk to this. What was our strat? Do you remember what our strategy was?
For which part?
To get out of debt.
I don't remember.
So this is one of those like emotional fallacies people get hung up on, is some people think, I'm going to pay the lowest balance first, so it's gone. And then I'm going to move on to the next lowest balance until it's gone. And I'll take that money I was paying for that one and put it into the next one. That doesn't save you money in the long term. That temporarily lowers your required cash outflow because you have one less payment to make. But you end up paying more interest rate over time if you're not focused on paying the loan with the lowest interest rate first, or the loan with the highest interest rate first, and save the loan with the lowest interest rate to last.
No, that's right. Yeah, I forgot yeah.
So people, because you were one of those people, you thought, oh, I have this little loan over here for $5,000. I'll pay that off first and then I'll move on. But that $5,000 loan only had say a 1%, I don't remember, but say a 1% interest rate, versus you have a $250,000 loan with a 20% interest rate. So that one should be first. It's going to take you forever to pay that off. You're not going to get to those other little ones for quite a while. So people feel like you have more debt because there's more debt instruments, but the amount of debt is actually going down faster when you pay the bigger one off, because that interest on that bigger loan, that monthly payment that you still have to make in the future, more of its principal and less of its interest, because it has such a high interest rate, versus those little loans, less of it changes because it's a much lower instrument if you pay it off faster. So general rule of thumb, if you have the cash flow, because cash flow is a little bit of a factor, but that aside, you want to pay the debt with the highest interest rate first and work your way down. Pay that off first. So if you have extra money to put towards it, pay that highest one first.
So and you see a lot of these people online. Does Dave Ramsey, does he push the little one first? I can't remember exactly what he does. I follow him. I love his stuff, but
the thing that some people have a problem with for his philosophy is he'll even push, because one of the concepts is if you have an investment that can make you more than what your interest rate is, the idea is don't pay your debt down, put your money over in that investment where maybe your highest interest rate's 10%, but you've got an investment over here making 15. You're making a 5% spread between the 10 loss and the 15 gain. So don't pay your debt down, invest everything over here, continue to make 15, and just make those minimum payments on the 10. I think he's against that, but I'm not 100% sure.
Got it. Yeah, I knew there was some back and forth with him, but at the end of the day, debt's part of the business, debt's part of the journey. And, maybe not for everybody, at least our experience, that's kind of how we lived. And now moving forward to this next phase, that's a pretty big phase for us. We are looking at pulling in different forms of debt. So my biggest thing is that all the experiences that I've been through, Stan's helped me with immensely. Debt is not the end of the world. It could be strategic. It could be needed. It could be the only option. So you just have to understand, what is your business? You have to understand, what do you need to personally do in order to get the business to the next level? And sometimes making these decisions and trusting your gut go against the mathematical side in the equation. You just have to do what's best for you, but make sure first and foremost, you have the right people around you that you can have intimate conversations with, where you're not sugarcoating things. It's got to be the numbers, and they will not lie to you. But everybody's strategy is a little bit different, and everybody's philosophy on how they navigate that world. This was just how we've kind of done early on and our expansion. So any questions, drop them in the comments, email, call, text, whatever. This has been a great episode, and don't be scared of debt. Use it as a thoughtful approach to become successful in the future.